Hi, let's start Module 2, Electricity Spot Market, with the first block that goes from bilateral contracts to the electricity pool. Bilateral contracts is, as the name indicates, a direct interaction and the result of this direct interaction between a buyer, so demand for electric energy, and a seller, so supply of electric energy. This exchange only involves these two parties, plus eventually a broker that is there to support the negotiation and to be used as an interface, as a buffer between these two agents that negotiate. Eventually, the system operator is going to be informed about these trades so that it knows how this is going to affect system operation. The use of bilateral contracts is to be seen as a decentralized way to have an electricity market and to manage the energy system, since all parties involved will negotiate with whoever they want and in a quite decentralized manner. The different type of bilateral trading that you may see out there, first of all, customized long-term contracts. You may think of long-term contracts, for instance, for nuclear power or hydro energy. These are very flexible contracts, since basically you can negotiate whatever you want with the broker serving as an interface. These are private transactions, and this is something that some agents in the market may like. All the conditions of the contracts, being prices, being terms, being quantities, will not be known to the others. However, because of the broker involved and all the practicalities, the transaction cost might be very large. This makes that as a consequence, it will most likely involve large amounts of energy and very long periods of time. Again, this might be something that agents like nuclear generators or hydro generators find quite interesting. Today, with the development of electricity market, it was thought that bilateral trading should also evolve to have lower transaction costs, with, for instance, over-the-counter or OTC trading. Why do we have lower transaction costs? Because the contracts are standard, and they will most likely involve smaller amounts of energy and shorter lead times. This eventually goes towards electronic trading, which is based on an electronic platform that would consistently match supply and offer bids. Remember what I mentioned in the previous block with the development of the intraday market. This is what electronic trading would be there for. When you use electronic trading, there are virtually no transaction cost, so the big problem with customized long-term contract is actually solved in a way. It's also very fast, and therefore it allows for trading until the last second. When you think of electronic trading, maybe you've heard all this late development with blockchain and peer-to-peer electricity market. This would be somehow a form of electronic trading for bilateral contract in a decentralized manner. If we place it into perspective, bilateral trading has a lot of advantages. Certain actors will like the privacy, certain actors will like the fact that it's decentralized, but eventually the pool, which is an alternative providing a centralized form of system management, has been increasingly preferred in Europe and some other parts of the world for the day-ahead market setup. An example of a successful day-ahead market in a pool setup is that of the Nord Pool spot that we have in Scandinavia and that has spread to other countries. It is Europe's largest power market. There is a very large amount of energy traded on a yearly basis, 505 terawatt hours in 2016, and this has increased since then. And if you think of the share of the pool in terms of the overall energy traded, the Nord Pool spot, so the day-ahead market, represents more than 80% of the energy traded, while the bilateral contracts will represent less than 20%. You may also be able to track year after year the average system price, also day after day, as all the data are publicly available on the website of the Nord Pool. In this module, we want to focus on pools and the auction involved, so from now on, we will move on from the bilateral contracts. So what are auctions in an electricity pool? Think of all our buyers, that's the demand, and all our sellers, that's the supply. Instead of interacting on a one-by-one basis and trying to negotiate for exchange of electric energy and for the price and for the conditions, etc., we define a pool. This pool is a centralized point where everybody is going to make an offer at the same time. We have a time during the day, which is 12 in Scandinavia for the Nord Pool, the gate closure, before which all should have made supply and demand offers. Also here, no one knows about what the others are doing. Only the pool is centralizing information about the offers of the participants. These offers are most likely quantity and price, defining a market product. This pool then has the responsibility to clear the market. Clearing the market means how we're going to match the bids for supply and demand from all these actors. Based on this matching, we're going to obtain a schedule. So that means how much is going to be produced by who, how much is going to be consumed by who, and eventually also prices. So how much are we going to pay for electricity? Eventually, when this matching is made, the system operator is informed about the trade so as to support eventual power system operation. Let's go through an example auction setup to illustrate how this works. Let's assume that the deadline for offers is the 29th of January at 12. The delivery period is the day after. It's called the day-ahead market. And the time unit that we consider is 11 to 12. We have quite a lot of offers. Well, it is a simplified market, but still it is a fairly long list for supply and demand. Let's look at demand first. We have offers for demand totaling 1,065 megawatt hours. As you can see here, there's quite a number of companies that would like to buy electricity from the wholesale market, and you may see these companies as retailers. We call them Clean Retail, L4U, EV Charge, etc. These different companies are different blocks of energy they would like to buy. So Clean Retail, you see here, appear several times, and some of the others may also appear several times because they might be willing to buy different amount of electricity at different prices. Here, the offers are specified in terms of amount and price, quantity and price. So the first company and its first offer is of 250 megawatt hours for a price of 200 euro per megawatt hours. So that's the price Clean Retail is willing to pay to get these 250 megawatt hours. So you may read all the lines in the same way to see what the different retailers are ready to buy at what price. Similarly, on the supply side, we have a number of companies, you might call them generation companies, that would like to sell electric energy through the wholesale market. As for the demand, these companies might appear several times since they might have defined different offers for different amount of energies they would like to sell at different prices. So the first company here, Rogue Trading, is appearing 4 times. Another company, Gebrown COP, so that would be a CHP plant in Copenhagen, I guess, is also appearing a few times, and so on and so on. If you were to read a line to define an offer, this offer is defined in terms of quantity and price again, and for instance, Rogue Trading, in terms of its first block, would like to sell 120 megawatt at a price of €0 per megawatt hour. So you might expect it to be wind or solar power generation. All right, now we have a lot of offers. How are we going to match all these offers for demand and generation? This is the principle of the clearing of the auction. First of all, we need to define what we call the merit order. The merit order is there to give some kind of priority to the different supply and demand offers to define who should get its electricity first or who should sell its electricity first. On the demand side, this is the curve that we obtain, the demand curve. It gives priority to those who are ready to pay the most. So you remember there was someone that was ready to pay up to 200 euros for a certain quantity. So this first block is defined by the quantity and the price of 200. Then the second one was ready to pay a bit less for its electricity. It will be ranked second or appear second in the demand curve, and so on and so on and so on. On the supply side, the merit order works in the opposite manner. The first one that may be scheduled is the producer that is ready to provide the system with electric energy at the lowest cost. So it appears here first. You remember rogue trading was ready to sell electricity at €0 per megawatt hour. This is appearing first in the supply curve. And then the second one with the second price level offer as its quantity appearing here, and so on and so on. Now that we've matched the supply and demand through this merit order, we see that the two curves are going to cross. They cross here at this point. And this point may be called a magic point. It is the point of equilibrium between demand and supply. Why is this a point of equilibrium? It is because of what we define social welfare and its maximization. Social welfare is assigned area here between the demand curve and the supply curve. Why do we call it signed? Because social welfare is positive here when the demand is above the supply, and it's going to become negative when the supply curve is above the demand curve. This equilibrium point is the point where supply and demand meet. And if we consider this point to define the schedule, this is the one that will maximize social welfare. So it will maximize the area between this curve. When we've maximized social welfare, how does that impact scheduling? Simply, those who are on the left of this point, all the suppliers and consumers that are on the left of this point, are going to be scheduled. So those who were ready to pay quite a high price for consuming, they will have access to the electric energy they wanted to procure through the market. On the other side, those who are ready to supply energy pretty cheap will also be scheduled, and so on, until at some point you will see these consumers here were ready to pay maybe 30 euros per megawatt hour to get their electricity, but those who could provide them don't want to provide electric energy at that price. So somehow it's not possible to match them anymore. If you think of this matching also, the part that is above this equilibrium point is called the consumer surplus, and the part that is below this equilibrium point is called the supplier surplus. Why is this called a surplus, and why do we split it between consumer and producers and supply? This is because if we were to define the value at this equilibrium point as the price for clearing the market, so here it should be around 37.5, you see that all the consumers that are scheduled, they were ready to pay maybe 200 euro per megawatt hour, but eventually they would get their energy supply for 37.5. So the difference is somehow a surplus, a benefit for them. On the other side, on the supply side, the first year, rogue trading was ready to supply electric energy for €0 per megawatt hour. But if the market is cleared at this price, 37.5, there is a benefit of 37.5 euro per megawatt hour. This is a surplus. All the consumers that are scheduled here, they will receive electricity at a price that is lower than what they were ready to pay. And all those who are going to supply electric energy through the market are going to be paid at least what they wanted to be paid for. Thank you for listening. Now I would invite you to use the self-assessment quiz to check your understanding.